This is where it gets back to gold. And I use gold as a catch-all for precious metals, including silver. The market share of precious metals relative to other savings and investment classes in the United States currently is less than 0.5%.
All right, wow.
Down from a 40-year mean of 2%. And by the way, an estimated market share in 1981, its peak in excess of 5%. I'm not suggesting that the world is going to sell all their long bonds and go into gold. I'm suggesting that the market share of precious metals will return to its 40-year mean, which is to say 2%. And if that occurs, demand for precious metals will quadruple. And that's what I think is going to happen. It's precisely what I think is going to happen. Prices are set on the margin. And I believe that that will be very, very good for precious metals prices. Will it occur in 2023? I don't know. Will it occur? I've never seen math lie. And I believe that even if I'm wrong, investors would be well advised to insure against the contingency that I'm right. It doesn't take very much gold in your portfolio to hedge against the sins that happen elsewhere in your portfolio. And to the extent that investors don't hold gold, and by gold, I mean physical gold or physical proxies in their portfolio, those people are in effect uninsured, which I believe, unless they are extremely rich and can self-insure, is very stupid. I don't think that in the first instance, people should buy gold just because they think it's going to go up. I think they should buy it as a way to maintain their purchasing power over the rest of their useful lives.
Yeah.
Buy it and in fact hope it goes down, because gold is insurance in its purest form, a medium of exchange and a store of value.
So Rick, would you say that just like the market fell in love with the Fed put over the past 15 years?
Yep.
Are you saying that investors should fall in love with the gold put going forward here?
Fall in love might be the wrong phrase. Do you love life insurance? Do you love home insurance? I think it's the responsibility of a mature adult to organize his or her life in a way that will give them the best outcome. And I think gold is an absolute component of that. I have no idea what's going to happen in terms of my mass psychology. I'm talking about your listeners taking action themselves to secure their well-being beyond beyond insurance. If gold does well, the major gold stocks should do very well. So an investor, somebody that's different than a saver, should look at the senior gold stocks. And the speculator, by the way, I am one, should look at the junior gold stocks, but understand that that risk stack involves a work stack. So if you aren't willing to work, just save, don't invest. If you're willing to work a little, invest. If you're willing to work a lot, then of course, speculate. And that brings us to silver, which is to say the ultimate speculative asset class, I would suggest in natural resources, but particularly in precious metals. And one of the reasons why I look at it so favorably. Let me just say this, all investors around the world are underweight precious metals precisely at the time that they ought to be overweight precious metals. So let's talk about the why before we talk about the when. We do that?
Great.
The first is geopolitics, which is on everybody's mind. In particular, the weaponization of the US dollar. The US dollar trying to export its policy preferences to other places in the world by utilizing its reserve currency status and SWIFT to punish other people for taking what we believe are un-American views. Many people in the world resent the extraterritorial imposition of US values on their cultures. Other cultures, Iran, Russia, China, India, Brazil, Mexico, Saudi Arabia for that matter, feel overtly threatened by the United States. And the idea that they would denominate their trade and give sovereignty to a country that imposes its will on them means that they are looking for means of settlement outside the US dollar. Much has been made about new cryptocurrencies, which is to say like the brick currency. I don't think that's a threat at all. My friend Doug Casey says the US dollar is an I owe you nothing. The euro is a who owes you nothing. And the brick is a nobody owes you nothing. The truth is that as little as these countries trust us, they trust each other even less.
Correct.
And I believe that gold, which isn't a promise to pay, but rather payment itself, will be a great beneficiary of the disintermediation of world trade away from the US dollar as a reserve currency. By the way, I think the US dollar will be the reserve currency 20 years from now. I just think its market share will be less than it is today. But let's stop blaming the rest of the world. Let's look at the United States in terms of why precious metals will do well. The debasement of the medium of exchange, which is to say the US dollar, and by proxy, the US Treasury market, is insane. First of all, let's look at the creditor. $32 trillion in recourse on balance sheet liabilities, 26 trillion net of the Fed's balance sheet. $100 trillion in net present value, not nominal values, net present value of off-balance sheet liabilities, Social Security, Medicare, Medicaid, veterans benefits, federal pension trust funds, $100 trillion. So collectively at the federal level, we're upside down over $125 trillion. And we propose to service this debt with a budget that's in deficit $2 trillion a year.
Mm-hmm.
The arithmetic is farcical. It's totally farcical. But just for fun, let's look at the yield. Let's look at the best historic savings instrument in the world. The deepest and most liquid is the US 10-year Treasury. Let's look at the value proposition for the greatest competition gold has. The thing yields savers 3.5% in a currency that the Congressional Budget Office, not some cranky old libertarian, suggests is depreciating the value of the dollar by 7% a year. So the US government absolutely positively guarantees that if you lend them money for 10 years, they'll cost you 3.5% of your purchasing power compounded every year for 10 years. And you know what, Adam? I believe them. That's what they'll do. Jim Grant calls this return-free risk.
Yeah.
So think about the fact that the principal competitor for gold and silver is return-free risk. And think in your own mind whether that's a mountain too high to climb. But it gets worse or better, depending on your point of view. Inflation and negative real interest rates obliterate the long bond market. And the long bond market is an enormous market, particularly relative to gold. Adam, imagine yourself as running a big university endowment. You're managing $30 billion, and you're going to look after the institution and the students 20 years from now and 25 years from now. And your portfolio is 60% long bonds, which have treated you very well for 40 years with declining real interest rates. Low interest rates, negative real interest rates, but rising interest rates obliterate the long bond market.
Right.
On the one hand, as interest rates rise, the capitalized value of distributions falls. So a 10-year Treasury, which was bought to yield 2, is less value than a 10-year Treasury, which is bought to yield 3.5. So the capitalized value of the bonds in these portfolios falls, which means that the contributions have to rise, but the legislatures won't contribute more.
Yeah.
At the same time that happens, the continued negative real interest rate, the spread between the interest yield and inflation, means that the yield on the portfolio becomes insufficient to meet the obligations that portfolio was set up for. So you now, rather than being an interviewer and an investor, you're a portfolio manager for a big university. The first thing that happens is that 60% of your portfolios are in bonds. As a consequence of the interest rate rise, your portfolio loses 25% of its capitalized value. Mm-hmm. And the legislature is unwilling to give you any more money. You are making your actuarial assumptions on the fact that over the last 40 years, you've generated an 8% annual yield. The problem is that because of writing down your bonds and perhaps problems with regards to the S&P, this year you're down 15%. Now, you don't have an immediate problem because of actuarial fraud. You are allowed to carry the bonds at their par value, assuming that you pretend that you're going to hold them to maturity because they're regarded as having no risk. But you have a real risk. You have a real risk because the bond yield that you will enjoy will be insufficient to maintain the needs of the university 20 years from now. Your only choice is to begin to disintermediate, which is an economist word for sell, some of your bond portfolio and go into another asset class.